So the first one we're going to look at is right down at the bottom. It's called the February open interest. Now, February is a minor month. It's not a big month, nor is January normally, although it was, but normally it's not. So February is there we go. I keep coming off it. February is a minor month, and the number of open interest, what we're looking here, this blue line right at the bottom, you can see there's almost no open interest in February because it's a minor month, and that's going down towards nothing at the moment. So we're almost there at nothing. The next line I want to look at, right at the top of the chart in green, is the March open interest. And we can see plotted over the dates, here we got start of January here, and here we got the 26th of February, which is the first date where we'll know if there's a problem. We can see that the number of futures contracts is falling towards zero. Now, that's perfectly normal. All future contracts, as they approach the maturity date, tend to go down. The trouble is this one's not going to reach zero on the present trajectory. It's going to reach, we're going to get to a figure where it looks like there'll be a severe shortage of about, we'll have 120 million ounces outstanding. And I'm going to talk about what that means, but basically it means the longs are going to take delivery of up to 120 million ounces. But there's a slight problem because the silver isn't there, at least not at the moment, and looks like it won't be there by the time we get to February. Because if we look at this chart, the black line, which turns blue here, the dotted line is the projection, we can see that the silver inventory has been falling. Here it was about 140, 150 million, 130 million ounces at the beginning of January, and now it's below 100 million ounces, and the trajectory is downwards. So if that trajectory continues, we'll be down at about 70 or 80 million ounces by the time the first delivery of the March contract comes, bearing in mind there'll be about 120, 130 million ounces demanded by the longs. If you've got a short who's unable to deliver or doesn't want to deliver on the first notice day, they can delay it, and they can delay it hoping that the longs will capitulate, but they've got a hard deadline, which is 1 p.m. on March the 30th. They have to have either closed their position by buying back the futures contract, if they can, if it's available from one of the longs, or they have to give notice to deliver by 1 p.m. on 30th of March. After that, there's no more time. And if they can't file because they don't have the warranted metal, and they can't buy back their short because the market's too thin or just too expensive, then they're looking at a failure to deliver. And that invokes the force majeure clauses at the CME. And we don't know what the CME would decide in such circumstances, but they could decide on cash settlement at a price that they choose, which means that maybe the buyers of silver wouldn't get the silver, they'd get a cash settlement, and then they take that cash and try and buy silver and find they have to pay twice as much. Based on present projections, that silver won't be there, so not all the silver can be warranted. So what are they going to do? They've basically got two choices. They can wait it out until the end of March, hoping that some more silver comes into COMEX, and they can buy that and deliver it. Or they can close their contract by buying back the silver, buying back the silver, which basically means that the price has to be high enough to entice one of the longs to sell it to them to match the deal. Of course, there are plenty of longs who are making a market, so there's always going to be a two-way price, so it won't be a problem. But they'd have to be net buyers to for their total open interest to go down enough that the rest of the open interest is covered by silver, which is actually there, which doesn't look like it's going to be the case at the moment. Let's go to what happens. Let's just talk about who controls the market. Effectively, the market is controlled by the shorts, not the longs. If you want to buy silver on COMEX, you just buy a future and then you wait for the current month, but you do not know when the short will decide to file an intent. And the minute it does, that's going to be matched up with one of the longs. It could be you or it could be somebody else, you don't know. It's a lottery. But if you haven't closed your position by the first intent date, the 26th of February, then you're likely at any moment to be told to pay, because don't forget the silver's on, you've got only paid with margin, you're going to be told to pay for the silver and the silver will be delivered to you. You have no choice about it. So those longs who have not closed their position by the end of February will be signalling an intention to receive the silver and presumably take it off the exchange and use it for something. So the short initiates the delivery process, not the long. The long just sits there passively in the delivery pool waiting to be matched, which can come any day in the month of March. The short decides when to file their notice of intention to deliver. So the intent date for March is on 26th of February, and I'll tell you what that means in a second. And then 2 days later, business days later, we have the delivery date, which would come on the 2nd of March. That's the first delivery date, but the shorts can still deliver silver right through the month. So if they can't get it on COMEX, they might wait, hoping some comes in, but hoping also that some doesn't get taken away, making it more difficult to buy. But at first sight, based on current trends, there's going to be a shortage of silver starting right at the start of the month, start of March, that is. Now let's look at the next slide to explain how the delivery process works. The first relevant date, which is coming up in 14 days' time, where are we, the 12th, in 14 days' time, 2 weeks, it will be Thursday, February 26, exactly 2 weeks from now. This is called the first intent day. This is the day when the shorts can decide that they want to deliver. And if they don't want to deliver, they better start buying back their contracts, pushing up the price of silver. But let's assume that they do want to deliver on the 26th of February. That means they give a notice of give that intention. The next day, the CME issues invoices, and the day after, the working day after, which in this case would be the 2nd of March, that's the second business day, then the silver gets delivered. Who's holding a March position can file their intention on any business from the first intent day, 26th of February, right through to the last intent day, March the 30th. So if they file on the 26th, they have to deliver on March the 2nd, but if they file 2 weeks later, they're not delivering on March the 2nd, they're delivering 2 working days, 2 business days after the date that they filed. But if a short can't get his hands on the silver or doesn't like the price, they can wait. They can wait until the very last moment, and the March contract will continue to trade throughout the month, although it become much thinner and much harder to trade as the month goes on. So that would obviously be some sort of squeeze, and the price of silver would be being squeezed higher, particularly if the longs aren't willing to close out their position. And why should they? If they got to the end of February, they presumably have the money to pay because they don't know when they're going to be delivered the silver, so they're just sitting there saying, I'll take the silver today, I'll take it tomorrow, I'll take it next week, or take it in 3 weeks, doesn't matter. I'll take it at the end of the month. They're willing to take it. So the longs are not under pressure, but the shorts are. So that would, in normal circumstances, push up the price of silver. Of course, the other thing which might change is there might be suddenly a huge surge of silver coming into COMEX from the registered silver, from the eligible silver, or from miners or some other seller like an ETF. But in all probability, for that to happen, the price has to go higher. First of all, the first number to look at is the registered silver, which is currently, for the first time, below 100 million ounces. Don't forget, a few months ago it was up at 160 million ounces. A few days ago it was at 110 million ounces. And now it's only 98 million ounces. So below 100 million ounces available in registered. Registered is the type of silver which can be delivered to meet a futures contract. But there's also on the CME 283 million of eligible silver. That's silver in the right shape and form, but it's not warranted. It can't be delivered unless it's converted to registered by getting the appropriate warrant. But in general, where it's eligible, it means it's held by people who don't intend to deliver it as a consequence of one of the futures contracts. But they can change their mind and they can move it backwards and forwards. But a lot of that silver will be owned by exchange-traded funds, by family offices, by sovereign wealth funds, by hedge funds and so forth. So a lot of that 283 million supply you see there wouldn't be eligible, wouldn't be convertible or converted into registered. But silver can move backwards and forwards between registered and eligible. But I'm just going to have a look at what's gone on yesterday. This is just one day's snapshot, but it will put it in context what I'm about to show you with some very interesting graphs in a few minutes. So what we see is yesterday there were 101 million registered ounces and we're down to 98 million ounces. What happened to reduce the number of registered ounces? Well, we can see very clearly that 3 million ounces, it's called adjustment, 3 million ounces went out of registered and into eligible. What that means is that someone somewhere decided, go back to where we are, someone somewhere decided to put 3 million ounces, take it away from being deliverable on a futures contract and put it into eligible, which means that it's sitting there, it could go back again. Now, the reason they might put it in eligible, perhaps the fees are less in the eligible section than they are in the registered section, something like that. But anyway, that's why the registered has dropped below 98 million. So probably what will happen is the silver price would rise so that we encourage some of the longs to sell their silver back to the shorts, so both sides actually close their position. Now let's look at these vertical lines. The first one, the first blue line, is the first delivery date for February. So those who had the February contracts, and don't forget they're very, very small, can basically they can keep their contract going if they want, and this is the shorts who can keep it going, but they have to deliver before the end of the month. And I'll explain the mechanism for that in a moment. But as you can see, it's really insignificant. The number of shorts on the February exchange month are almost nothing, and they've almost all delivered already. But that would be the first delivery date. Now, the shorts can choose to deliver on any date right through to the end of the month. These numbers will definitely change, and we won't end up in a situation where there's less silver than there are longs, because what's likely to happen is that the price of silver will rise as we get closer to the delivery date, because no short wants to be squeezed at the last minute. So they'll start bidding up the price to entice the longs to close with them. So the price will probably go higher, and this is just my assessment, not investment advice. I don't know anything about investments. I might be a complete idiot here, but I think the price should go higher as we get towards this crunch date, 24th of February. Now, if you like what I've been saying, you can hit the like button. If you want more of these, hit the bell button. I will keep people posted as we get nearer the month, because as we get nearer to the 26th, 27th of February, we will know for sure if there are still longs out there which exceed the total supply of silver in the registered category. And if that's the case, you could expect another almighty squeeze upwards in the silver price. But I don't know that's going to happen. I'm not forecasting it to happen. I think it won't, because I think people are more cautious than that. So I think they'll be buying back their contracts during this month. And I think maybe some silver will come into the eligible category, which could then be converted to the registered category. But overall, I think the silver price probably goes higher to make this happen.